Today, folks, my mother's friend is a sheep shearer, and we had a conversation today. I grew up on a farm. My mom, being a sheep farmer, knew this gentleman who's done exceptionally well for himself from an investment standpoint, and he called me today. We had a discussion about if he should be investing into these trading crypto platforms. Obviously, my answer to that was going to be probably not the best idea unless you're really heavily into speculating, but being Canadians, the conversation once we get into investing will always round back to the idea of Canadian bank stocks. In this world of high-flying tech where valuations are hard to wrap your head around, in Canada, I still can't help but believe that these Canadian banks right now are the buying opportunity of a lifetime. And I want to share with you some of the information around the Canadian banks and why I think they're poised to perhaps explode sometime within the next 1 to 3 years. When I mean explode, we're not talking about tech stock Teslas to the moon kind of explode. You can buy those for other aspects of your portfolio, but if you're looking for income today and something that I think is favorably valued into the future, I still think, yes, no one cares about Canadian bank stocks or dividend stocks right now, but this is where the opportunity, in my opinion, lies within the market. So we're going to look at the primary largest banks. We're going to look at Royal Bank, Toronto Dominion, Bank of Nova Scotia, Canadian Imperial, National Bank, and BMO, just to see what the fundamentals look like today, so you can kind of decipher for yourself what ones perhaps would be the best buying opportunity. And at the end, I'll share with you what my favorites are. Now, what I'm going to share with you should technically blow your mind, because we're going to be talking about all-time high revenues out of these banks for 2023 in a time where even Apple can't hit all-time highs with its revenues. So why are these banks pulling back? A lot of it hinges on what's about to happen in the Canadian real estate markets. If we start seeing mortgages default at a high rate, it's going to hit these banks incredibly hard. You might be hearing that Canada has the highest mortgage debt of pretty much any G7 country, but we also have the highest credit rating debt of pretty much all the G7 countries as well. So it's a catch-22. Is Royal Bank right now year-over-year quarterly growth hit pretty much a decade high at 20%, which is pretty astounding and comparable to the last decade. And from a dividend standpoint, these things have become very renowned. I mean, we've survived every recession. When I say these banks are recession proof, that isn't meaning the stock can't go down in a recession. That just means these things are likely to survive and come out on the other side without declaring bankruptcy or default like we're seeing with US banks. And we've gone through the 1980s or the 1990s and 80s crashes, guys, the dot-com bubble, the 2008 financial crisis, and they never cut the dividend once. A very astounding long track record, making them probably, well, this is why Royal Bank's the largest company in Canada. But again, what I want you to fixate on, not to bore you too much with numbers, is look at the total revenue here, which again is going to hit an all-time high this year, sitting at $13.5 billion for the last quarterly report. If we take a look at the same time last year, it was $11.2 billion, and the same time, to the year prior before that, we were sitting at about around 11.6. It's basically been growing consistently here, and that probably is related to higher interest income. On a 6-month basis, if we zoom in, we can see that we're sitting at about 28 billion versus 24 billion. But again, all of this is in relation to them putting provision for credit losses aside, which for the last quarter was 600 million, which is the highest basically from all the prior quarters, going all the way back to even Q2 of 2021 when it was only 96 million. These banks are throwing money aside just to be prepared for the event of a complete credit collapse. And honestly, you got to ask yourself, is that something you think is going to happen? If it is, there's a reason these banks are selling off. I should point out Royal Bank is going to be acquiring HSBC. That is another Canadian bank, but they're purchasing the Canadian counterpart of that bank, which is going to obviously add to more of their revenue growth. Toronto Dominion was trying to do the same acquisition targets with First Horizon, which would make them the 10th largest regional or the 10th largest bank in the US, but that deal fell through because regional banks are collapsing and there's fear of their balance sheets. And that led to TD dropping 25% from its last year high with a current starting yield of 4.81%. And taking a look here, again, before we actually look at the boring numbers, because I know all of you want to look at the juicy dividend yield, we can see that the quarterly or the year-over-year quarterly growth is 13.6%. The dividend growth here, guys, also astounding. I'm not sure what the drop is. I'm presuming this would have been a split. I know TD's done some splits in the past because I don't recall TD ever being a company that has ever in its history cut its dividend. But take a look at this right here. And again, we're going to go over all the banks so you get some comparables on what ones are preferably probably the best buying opportunity. Total revenue at $12.3 billion. If we go back to the same time last year, it was like, what, $11.2 billion? These growth numbers are amazing. But again, provisions for credit losses is almost $600 million, the highest it has pretty much been for most of the prior quarters. These banks are protecting themselves again. So that's just to give you an idea that all these banks are still growing revenue numbers. It's crazy to me these banks are able to sell off so aggressively in a time where they're seeing some of the best growth on revenue they've ever seen. It's just not hitting their bottom line because they can't show net or the provision for credit losses. They have to write that off against the net income, so it's not showing up on the EPS, and that's making people terrified of these banks. Look at Bank of Nova Scotia down 28%, a 6.3% starting yield, and again, same deal. Net revenue here, guys, 7.9 billion. Pretty crazy, right? But there's no growth. Unfortunately, Bank of Nova Scotia, though yielding the highest, we can see it hasn't actually seen the same kind of growth year over year here. If we take a look at the 6 month, it's sitting at 15.9 billion versus this time, prior in 2022, where it was 15.99. So they've actually seen a decline in revenue. And again, provision for credit losses are still stacking to the ceiling. 709 million, guys. They're definitely protecting themselves. Bank of Nova Scotia over the other banks, Royal Bank is more Canadian focused. Toronto Dominion is trying to expand into the US. Bank of Nova Scotia gives you that foreign exposure. I think it's more focused on Latin America and Canada. So you can see the diversity that varies between these banks. And again, Bank of Nova Scotia, same history of incredible dividend growth. But how does that compare to Canadian Imperial Bank? Another more kind of Canadian focused bank here that's trading down pretty dramatically, that has heavy exposure to the Canadian real estate market, down 34% with almost a 6% yield as well. Taking a look at the revenue standpoint, $5.7 billion for this last quarter. And if we just trail back to the same time last year, it was $5.3 billion. And if we go even farther back, it was in the $4.9 billion era. For the 6 month ending, guys, we can see they went from $10 billion to about $11.6 billion. That's pretty astounding, guys. They're still able to grow. But again, provision for credit losses are ruining their net income. It's taking away from that net income, right? And CM, look at the growth of this guy. Going back to the 90s here, 30 years ago, you'd be getting 8 cents a share. Today, you're getting what? A whopping 87 cents a share. In 30 years, you've seen a massive, massive increase, 10x. Damn, I mean, could you imagine 10xing your dividend income in 30 years? There's not many businesses out there that can state that, right? So look at National Bank, paying a 4.17% dividend yield. This has been one of the better performers, only down 7.28%. And taking a look at the total revenue, again, not paying attention to anything else, 2.4 billion. Let's see, versus this time last year, what were they doing for Q2? It's about 2.43. So they are seeing growth. It's not as astounding. Let's take a look at the, can we take a look at the year-to-date total? They're sitting at about 5 billion versus 4.9 billion, about 100 million more than this time last year. And again, I don't need to point out provision for credit losses because we all know they're stacking more money than they ever have. Again, National Bank of Canada, let's take a look back in the 90s here, paying about 5 cents a share. Today, paying about $1. Baby. Whew. Hard to wrap your head around that kind of dividend growth over a 30-year period, right? BMO, the final, a PPC in favorite. I know some of the U.S. dividend investors like getting Canadian bank exposure, and Bank of Montreal give you that kind of exposure. It got hit of the hardest in the pandemic era because of its loan exposure to oil companies. It does have some rather large loan exposure to the energy sector with almost a 5% dividend yield and down 22%. Again, just take a look at the dividend growth from the 90s here, paying about 13 cents a share, whereas today we're getting about what, $1.47. Canadian banks are like Canada's premier businesses. They're recognized globally for the security and safety and income growth, and all of these banks are exemplifiers of that as they still exist from the 90s. Not one of them became a Lehman Brothers, and it's really nice to see that. Taking a look at the revenue here, guys, sitting at 8.4 billion, and are we getting a bit of a decline here? Well, let's take a look at the same time in 2022 was sitting at about 9.3, so it looks like they are declining a bit in that revenue. But over 2021, where it was sitting at 6 billion, over a 2-year period, that is still pretty nominal growth. It's kind of, I wonder what drove such the growth in Q2 of 2022. BMO, if we take a look at their quarter over quarter, it seems a little bit choppier. So let's just take a look at the year-to-date total, sitting at 14.9 billion versus 2022, where it's 17 billion. So it does look like there is a bit of a decline, but from 2022 over 2021, still growth, right? But it does look like there's a pretty substantial decline for this Q1 over 2022. I am not sure what would be driving that, but if we had to put it in comparables here, it looks like Royal Bank, Toronto Dominion Bank, and Canadian Imperial Bank, and probably National Bank as well, are some of the still best revenue growers during this tumultuous market, probably mostly driven by net interest income. And the fact that Royal Bank does fixate on mostly Canadian, non-foreign investors, just Canada focused, which means when you get a lot of population growth, which Canada is experiencing, they're all going to flood to the most Canadian banks, right? Which would probably be TD and Royal Bank of the biggest. So I imagine Royal Bank will see most of the benefits from the Canadian growth, and it's one of those banks I think everyone should have in their portfolio. Or again, you can get through monthly paying ETFs like VDY or Canadian exposed bank ETFs, but you want ones that don't equally weight. You do want the upper exposure to the best Canadian banks, and that would be Royal Bank and Toronto Dominion. But I'll pass that question off to you. I'd love to know what you think in that comment section below.